Hello and welcome to this webinar presentation where we'll be looking at the impact of the pandemic COVID-19 on the accounts, particularly the accounts of small, medium-sized owner-managed businesses. My name is David Potts and I will be presenting this session for you. This is a session which was originally delivered for Quintama in September, but the original recording unfortunately was not of suitable quality, so this is a repeat presentation of all the key issues. The second half recording is going to be available as well, but this is just the first half of what we covered. The objectives, obviously, for many people as we've been working in remotely working from home, is that the pandemic has had a huge impact in so much of everyday life, how we socialized, how we would liaise, keep up to date with family, and also notably there were so many accounting issues which were immediately raised, and this session was designed just to keep you up to speed with all of those most important issues. I've looked at all of the relevant technical guidance in putting this together. Actually, there have been no real changes to the accounting regulations as such. There were one or two minor just clarifications, but the idea was that, you know, the world had changed. It wasn't the accounting regulations. The other thing which obviously happened in the middle of all of this was Brexit, which had been much more widely anticipated, not the exact form of the withdrawal agreement, but a lot of the issues are going to be the same, and there is going to be this big overlap between what impact COVID will have on the accounts and also what the more ongoing impact Brexit will have. So the programme was to start with just an overview of what is the situation, what is the accounting implication. So if you are obtaining accounts, looking at it for a particular application or client review or whatever, just what are the issues to be watching for. The first issue was around timing through from 2019 through to 2021. When would this start to have an impact on the accounts? And what actually would that impact be? What we will then do is spend the majority of the session looking at the specific accounting issues. So which numbers are likely to change and how? And then the final part of the session will look at the more kind of cosmetic issues. How is this information going to be presented? What particular additional disclosures might you see if you actually get into the kind of details, although saying that, very small companies often don't produce much in the way of detail at all, so there is not really going to be, you know, that much given away there. In putting this course together, I have considered all of the relevant guidance almost immediately as soon as the pandemic became known, became realised and recognised. There was guidance issued by the Institute of Chartered Accountants. They provided a checklist of things to consider almost immediately. And around the same time, the Financial Reporting Council also started issuing guidance for company directors, for preparers of accounts, and for auditors. The government response regarding accounts was very, very limited. There were a few concessions granted by Companies House. Probably the most notable was the timetable for filing accounts was extended. So rather than you getting accounts normally at the latest within 9 months of the year end, that was extended to 12 months. Now, initially you had to apply, but then it was granted automatically. There was a couple of other concessions, but they're more kind of technically around having to have general meetings, how you would hold them during lockdown. For those using the international financial reporting standards, there was guidance almost immediately available from the big audit firms, but that is obviously more of an issue for larger and listed companies, which is not really the focus of this session. So the first thing really to just try and get clear, when will the pandemic start having an impact on financial statements? When will this become an obvious, evident issue? Now, the thing to appreciate is that when you get to your reporting date, so when you get to your financial year end, which obviously you can pick whatever year end you want, you do have to consider if there are any subsequent events in the period from the year end to when you finally approve the accounts, which have to be taken into consideration. Now, the events fall into two categories. Certain events mean that you've now got extra information which relates to an existing condition at the balance sheet date. And that is what is referred to as an adjusting event. And what you will then do is go back and change the numbers if the numbers haven't yet been finalized. If the numbers have been finalized, it's too late. And then you're into the realms of, you know, what the directors might be happy with, what the accountants maybe can assist, and just hoping it doesn't get into the hands of lawyers. That is fairly rare. The alternative is a non-adjusting event, which basically is that you've now got information relating to something which has happened after the balance sheet date. And if that is the case, you do not change any of the numbers. All you would maybe consider doing is disclosing this in the notes and giving some numbers if you can assess the impact, but the balance sheet would not change by 1 penny. The importance of this is we need to nail down, when did the pandemic start? When did we actually realize that this wasn't just going to be an issue for China, a cruise ship in Singapore, and it wasn't going to be something that you could just kind of allow herd immunity to take care of? The pandemic was announced on the 11th of March 2020 by the WHO. So at that stage, it was now obvious public knowledge. And it was then I started to see events being cancelled. You started to see people being reluctant to travel. People were much more likely to wear masks. I mean, admittedly, this country was slow to kind of maybe gauge the seriousness. I mean, in that week before the announcement, I had been to a major football match up in Manchester. 76,000 people happily enjoyed it. Well, most of them. No masks, no social distancing. There was then the Cheltenham Festival, same thing. But then by the end of that week, it was a global pandemic. Now, this is important because what it means is December 2019 is before the pandemic. This is when it was still seen as a localized issue in China and East Asia. And therefore, when you get to your December year-end balance sheet, there is no reason that the management would have known that this was going to be happening. And therefore, even though these accounts were probably not filed and completed towards the end of the following year, it would still just be seen this huge change to our lives as a non-adjusting event. You would make additional disclosures, you would maybe quantify them, but it would not change the accounts. Now, when you get into 2020, there was a little bit of kind of confusion because at the end of January, at the end of February, there could still be a clear argument. You know, we were still being told by our leaders, you know, wash your hands, try not to get too close, we'll be fine. But obviously by the end of March, we'd all been locked away. We'd all been told to only leave the house if you're a key worker or for daily exercise. We knew it was serious. So definitely when you get to, I would probably argue 31st of March 2020, definitely. So those accounts, which again should now have been signed, sealed, delivered, it would be an adjusting event. You would adjust the numbers. So that's the key issue regarding timing. And it is this sense that obviously when you're looking at, if you're asking for the last 2 years accounts, 3 years accounts, 2020, yes. 2019, it will not be there. However, the other issue which was raised by most regulators was, this is still a big situation. I mean, I think we would probably all know businesses which, although they existed pre the pandemic, very successfully, very healthily, they no longer exist. I was looking recently to go out for breakfast in London, and in the past I have been to Simpson's in the Strand, which has been there for hundreds of years, and it is not open. And you're finding again, oh, they haven't reopened. So a lot of businesses have found this meant that they were no longer going concerns. So you would have to consider if that basis of accounting was still appropriate. Every company had to consider it. Now, obviously, if you really don't believe you're a going concern, you shouldn't just be carrying on regardless, producing your accounts, trying to trade your way out of it. If you really don't feel there is a realistic chance of paying your debts as they become payable, you should stop, seek legal advice, see an administrator, an insolvency practitioner, and do the right thing. But even if you have significant uncertainties, and a lot of businesses have been propped up by economic support till the end of September, and therefore with that support, you could say that there was the ability to survive. We can scale down, we can furlough our staff, we can survive. And therefore, we are a going concern. But obviously there would be a huge uncertainty around this. So all companies should have been considering that. But obviously, until you know what is going to happen over the next 6 months, you would never be able to say for certain. This is not a kind of tick box technical exercise. And also, right in the middle of this, we had the end of the withdrawal agreement with the EU, when the realities of Brexit became clearer. And although they've been kind of merged in terms of, you know, all of the various shortages, empty shelves, lorries being parked up, and there's been things like, you know, a shortage of containers to bring stuff into the country, not helped by the container ship getting stuck in the Suez Canal. A lot of these judgments have just become that much more difficult. The FRC's guidance is obviously more focused on larger companies, but it is still relevant technical guidance. And it is just saying, you know, that this is likely to be an important area which should be looked at much more seriously. There are more potholes in the road ahead. There are more uncertainties than we've probably ever had since the financial crisis, when, you know, from week to next, you didn't know which major organization might be about to fail. You look at different outcomes, you look at issues specific to your entity. Now, I mean, I do appreciate if you're a delivery company, if you're a haulage firm, if you supply antibacterial sprays and wipes, it has been a fantastic time for you. If you provide PPE to the NHS, you've probably made more money than you ever have in your life. So it is impossible to generalize. And so if there are no material uncertainties, you probably don't even need to mention this. However, for things like maybe hospitality businesses, restaurants, things like concert venues, holiday related businesses, if you do kind of villa bookings overseas. What it suggested you should do is reverse stress testing, which is really to ask the question, what is the event or circumstance which could mean we are unable to continue? And then you work back from there. You work back to see what you can do to avoid that situation. So that is what has been happening around the kind of the longer term future of the company. So if you're looking at a set of accounts, there should have been this detailed review as to what our future prospects are, probably more detailed in bad times than in good times. I mean, at the heart of this is this question, and whether I asked it in September or whether I ask it, you know, this morning, I don't think anyone really knows. When do we expect life to return to normal? And well, obviously, it first depends what you decide is normal. What do you consider to be normal? Do you consider it to be the WHO announcing that the end of the pandemic is here, so you can all go back to work full time? You can open as much as you like. You don't have to wear masks. You don't have to distance. Or do you apply different criteria? That's your call. Whether you think it will be by Christmas, next spring, 2 years' time, you just have to build that into your estimates. When do you think the impact of the agreement we achieved after Brexit will stop having an impact on our lives? When do we think that trading arrangements will settle down? That a lot of these new trade deals, which have been long promised, will start to materialize with the big economies around the world. You know, like, I mean, obviously we haven't really got a deal, many would say, with Europe, certainly not regarding services. But what about America? You know, what about some of the other big emerging economies? Obviously, the bulk of the session will concentrate what impact will this have on the numbers being reported. And the first issue is never an easy topic: asset impairment. And this is everything from looking at your tangible assets, if there are possibly intangible assets on the balance sheet, and also your current assets. It is a requirement that if you've got an asset recorded on the balance sheet, if the amount recorded on the balance sheet is higher than what you now consider to be the recoverable amount, you have to make an immediate downward adjustment. That is what is called an impairment loss. It is ultimately a judgment call that you're now saying the future recoverable value from the asset, either through selling it or carrying on using it for as long as you can and then selling it, if that is less than the value in the books, you have to make an immediate downward adjustment, and that is recorded as an expense. It can be reversed. So obviously, if it was specifically related to, well, either the kind of COVID restrictions, you know, if you're a nightclub, you haven't been able to open. If you can reopen, you could say, well, everyone's back in great numbers. We're no longer impaired. I mean, our local nightclub from where I live is just over there. It's called Batchwood. And during the pandemic, it became a vaccination centre. So you would go to the local nightclub, you would sit underneath the kind of mirror ball and have your dose of Pfizer or AstraZeneca or whatever, and then you would sit and recover in the smoking marquee, and then you would toddle off home. Obviously, it should be now back open. Does that mean any loss of value has disappeared? Highly subjective. If you ask 3 accountants, they'd probably have a different opinion, and an auditor would have a different one again. And it is not just an issue for things like property, land, buildings, equipment, etc. Now, a lot of those assets, you will have already considered what is your future expected use of them. Are you going to carry on using them as originally planned? Are you maybe going to look to replace them early? What has happened to their residual value? I mean, a lot of things, you know, I don't know, office furniture that you would use in a big open plan office might be particularly surplus to requirements now for a lot of businesses. Now, the other aspect of this, there's obviously the timing issue, which we've mentioned. An impairment review is based on indicators which existed at the year end. So when we're looking at, again, December 2019, your impairment review was based on what you knew at the time. The fact that we knew within 10 weeks that the world was going to be closed down is irrelevant. December 2019, no impairment. March 2020 and beyond, you would now have to start doing those impairment tests. Anything which suggests a loss of value is called an impairment trigger. And the general consensus was, for all companies, the pandemic announcement was an impairment trigger. You had to think about it. If you haven't thought about it, then you haven't properly prepared your accounts. So if we go to some of the two main ones on the balance sheet, looking at things like your stock, your raw materials, your work in progress, your finished goods, well, what has this announcement done to their values? The good news is, with owner managed businesses, if you're looking at 12 months to complete your accounts, you can probably say for the vast majority of stocks that if you haven't sold them within 12 months, they're valueless. But then that is very industry specific. If, for example, you're a pub, yeah, the beer just won't last. You're going to have to give it away. You're going to have to sell it cheap. But if you've got things like whiskies, vodkas, gin, that's going to last. You can't generalize. The other problem with stock is the cost normally includes the transport costs. And what I have been hearing all the time is that transport costs have been rocketing. The cost to rent a container for a container ship, because so many are kind of parked up in China, unable to move. So many lorries are kind of parked up, unable to get things through the ports, that the cost of carriage is becoming more and more expensive. If it is considered an abnormal cost, you should treat it as an expense. But how do you call that? How do you decide? Also, what's going to happen to prices? Now, all of the suggestion is that selling prices are going to be going up. We're going to have inflation, so that could help with these kind of extra costs. But again, it's going to be very, very industry specific. With debtors, if you have any objective evidence that someone who owes you money is not going to be able to pay you, and their lack of solvency exists at the balance sheet date, you should provide for it. Now, this is not new. That is a bad or doubtful debt. But that is based on those people who were unable to pay you at the year-end date. Now, the issue around this is if their loss of value is purely because of what has happened as we've gone through the pandemic, the fact that the first attempt to open up last summer didn't really work, it didn't stick, and we went back down into lockdown. And then we've had other kind of hits like the Brexit deal. If it is something which has happened in the future, which has changed the expected recovery of the debt, you do not record an impairment loss on your balance sheet. Now, under IFRS, under the international accounting, which is not so widely used, that is now a requirement. You are required to look and think, well, given what's happened so far during this situation, what do we expect to happen over the next 12 months? But that is not currently a requirement under UK. So, for example, if you had trade debtors of £1 million and your average rate of bad debts is 1% of your debtors, if you look at the evidence over time, it's 1%. If you consider that is a reasonable percentage for the future, and if you have a bad debt, you normally lose 90% of the recorded amount of the debt, how much would be the expected credit loss? Well, 1% would be 10,000. So you're expecting 10,000 of debtors not to pay, but you would expect to only lose 9,000. So you would have a 9,000 expected credit loss. And that would be deducted from your debtors and charged to P&L. But that is only the kind of larger companies using IFRS. This is not allowed under UK GAAP. Again, probably the biggest issue here is if you're looking at assets which are required to be reported at fair value, this will mainly apply to assets which are held for their investment potential. Now, this will include things like financial investments, shares, bonds, government gilts, securities. And if you hold them for their investment potential, you have to value them at each balance sheet date at their current market value. This is likely to be an issue for banks, fund managers, insurance companies, not really much beyond that kind of cohort. However, if you hold property as an investment, if you have, as it is called, investment property, this is also required to be valued at its current market fair value. So if you're looking at a set of accounts, and let's say it is December 2020, you've got some investment properties. Again, we're just about to head into lockdown. We've been spending Christmas on our own, largely, if we followed the rules. And we're now about to head into our longest period of lockdown, where pretty much for January, February, March, until early April, we were not really allowed to normally travel or socialize. How would you value a property? Now, you would normally ask the Royal Institute of Chartered Surveyors for some kind of estimated value. They were telling their members any valuation should be considered at best within a range of accuracy. It could be plus or minus 10%. So the valuations on the balance sheet are highly judgmental. Now, the other thing as well, any valuation which is based on what is going to be the future potential for that asset. I mean, I read yesterday that we are expecting inflation up to 4%. We're expecting interest rates to go up to 1% within a year. So that is a 10-fold increase in interest rates. We're expecting a hit to GDP in terms of both Brexit and COVID of 6%. And actually, most of that is to do with Brexit. All of these future predictions, whatever you were doing in 2019, well, at that point, we didn't know about the pandemic and we didn't know what kind of deal we were going to finally get on Brexit. We now know. So those estimates have to be considered. As a result of the pandemic, I mean, there are a whole range of issues which have been identified. A lot of companies have reorganized, have restructured, have maybe combined offices into one, have changed teams. A friend of mine who works for a financial services company has been relocated and relocated back again to where she originally started, all during the pandemic. So there are a lot of management actions which have been taken to cope with this, maybe more in larger companies. But the thing to appreciate, if you want to put a liability on your balance sheet, and let's say you're now thinking, okay, because of the pandemic, we're going to have a really good 2019. 2020 is going to look probably rubbish. 2021 might start to look better again. Is there any way we can get all the bad news back into 2020? Can we provide for provisions, for contingencies, so that anything related to the pandemic, anything related to Brexit, when the deal was kind of agreed, is referred back to that period? Well, that is what we have referred to in the past as big bath accounting. That is what is often referred to as future-proofing your results by putting some surplus in a cookie jar. They call it in America cookie jar accounting. Or what you're basically doing is overstating the bad news in 2020. So in comparison, 2019 looks so much better, and therefore people might be pleasantly surprised. So the accounting standard requires, to stop you overstating the bad news, you have to demonstrate 3 qualifying tests before you can record a liability on your balance sheet. First, there has to be a clear obligation at your balance sheet date to make a payment to a third party. If there is no what we call obligating event, you cannot put a liability on your balance sheet. The obligation can be contractual, which is most of them. So it's things like you've got a supplier's agreement, you've had a delivery note which you've accepted, you've signed a lease agreement, you've got a bank loan. But a liability can also be created by an obligating event which is constructive. This is where, through your action and behaviour, you have created an unavoidable expectation. So it could just be something like a formal announcement. You've served notice to the staff that you're going to be closing a particular location. My daughter works at the Science Museum, and at the middle of the pandemic, they said there's going to have to be redundancies. And at that point you think, well, okay, I can probably be relaxed. Then they said it's going to be 35% of those people working front of house on customer services. That's where my daughter works. So then she could say, my job's on the line. The company could then say they have a constructive obligation. But even then, you only record a liability on your balance sheet if payment is probable, and probable is more than 50%. If it is not more than 50% likely that any payment will be made, you do not include a liability. That is what we define a contingency as. It is when the likelihood of payment is less than 50%. It's possible. And then even then, you've got to be able to put a reasonable estimate on it. And this is another area where accountants and auditors are really being challenged but basically being told, do your job. We don't think there is a robust enough challenge of the numbers. What we often look at is that they've done the calculation properly, not that the calculation was based on proper assumptions and estimates. What it's really saying is, if you're an accountant, if you are a proper qualified accountant or auditor, you should make your own mind up. You should know the company's situation in enough detail that you could suggest your own valuation. This is a major issue for many reasons. Luckily in the UK, unlike under IFRS, the International Accounting Standards, we have decided not to change our accounting standard for leasing. So we're keeping the same accounting approach as really we've had since about 1987. So in that regard, it's the good old days. But there are some real significant issues with leases, and particular with the payment of rentals. The big concern was, what if your landlord has granted you some kind of concession? What if they've given you a rent-free period? What if they've allowed you to pay a reduced rent? What if the landlord is one of the directors of the company and the asset is actually in their SIP and they are renting it to themselves, and to support their company, they have reduced the amount of rental which can be paid during the pandemic? Now, what it normally says within the accounting standards is, if you get any kind of concession, you will allocate it over the lease term. So if you've got a 5-year lease that you've signed, and for this brief period of a couple of months during the worst of the pandemic, you tell your occupant, your tenant, don't worry about paying rent, we're under lockdown, take a breather. And if they say gave you 50,000 of concession over the period, you could reduce your rental by 50,000. What you would then have to do is spread that over 5 years, or whatever is the remaining length of the lease. So that might then be allocated over the next 4.5 years at 10,000 a year, roughly. And that would be treated as a deduction to your taxable income over those next 4.5 years. Well, a lot of people were saying, hang on, this is ridiculous. This concession relates to the pandemic. Why can't we, as an alternative, just recognise it over the period that it relates to? So eventually, and it took until October of last year, eventually it was agreed that that would be an option if you met the qualifying conditions. Now, it's as with all things, as soon as you start getting into the detail, it was slightly more complicated than was originally thought. It does cover temporary rental concessions, but they do have to be a direct consequence of COVID. Can't just be a renegotiation, which you were going to do anyway. It is only available for a limited time. It is not going to be a permanent change. It is just for why we feel we need it. And the required accounting treatment will be, if it is a COVID-related concession, you allocate it on a systematic basis over the period that the change to your rentals is designed to compensate you for. Now, obviously, normally the amount of rent charged in the accounts, ignore the cash payments, the amount of rent charged in the accounts is what is tax deductible. And also, you would have to look at each lease separately unless the concession was negotiated on an aggregate basis. So if you were someone like, I don't know, who survived, let's say you're someone like Nando's, and you negotiated across your network that all leases would be at 50%. You would apply it across all your leases. The ICAEW has added some more guidance. You know, by a concession, it must be a reduction. It can only be a reduction. The rental change is strictly only for concessions granted. Well, initially it was to June this year. That has now been extended round to June of next year. So they are still leaving this concession. Potentially that businesses will not be fully operational until June next year. And we've had other concessions being announced recently, like business rates concessions. There can be no other change to your terms and conditions. It has got to be a reduction, not a deferral. And it has got to, again, relate 100% to the pandemic. So if you've negotiated a concession at the same time as maybe negotiating other changes to your terms and conditions, you've got to spread it over the lease term. So I thought I'd give a numerical example of this, just so you can see it in action. I mean, you could work it out. You could pause here and see if you could work it out. It covered the first period of lockdown. So we're looking at the lockdown period, which would be in the year ending, well, could potentially be up to year ending December 2020, March 2021, potentially round to June 2021. So there could still be some accounts where this has not yet been presented. You normally pay £10,000 per month, but you were shut down between the 23rd of March and the 14th of June. That was the first lockdown period. That was the first lockdown. I've kind of put it to the back of my mind a bit, and all of the things like the kind of tier system, which then came in, and then we had the second lockdown. Obviously nothing as bad as Melbourne, with their 240 days plus or whatever. So the landlord eventually agreed to not charge any rent for April and May to compensate you through that period. Unfortunately, just to make it as complicated as possible, your year end is slap bang in the middle. You prepare your accounts to the 30th of April. So you've got to do your 30 April 2020 and your 30 April 2021. How are you going to allocate the rent? If it relates 100% to the pandemic, you would allocate the 20,000 on a systematic basis over the period of compensation. And the guidance from the ICAEW is the period of compensation is not April and May. It is from March to June. That is what you're being compensated for. So you would add it allocated over the 84-day period. How many days were we locked down in the year up to April, where we were locked down the whole of April plus those additional days in March? 8 or 9? I think it's 9. We'll see in a moment. And then how many days were we locked down from April onwards, the whole of May, and 14 days in June? So that would be the basis of the calculation. So we would take 39 days of the 20,000, 39/84, which would give us an expense of 110,714. You can't take the full 20,000 credit. And then we would take 45 days of it, 10,714, into the second period. So those would be your rental expenses. Now, it hardly makes any real difference, but strictly, that is the right way to be doing things. That is the only change we have seen to accounting standards. That is the only tangible area where it was felt we needed some kind of review. There's a few other points made. As I say, if rent is just being deferred, you would still record it as an expense and you would just build up a liability accrual. And any rent at the moment which is due after June 2022 is no longer covered. So any periods after that. Let's hope, and I'm certainly hoping that it doesn't have to be extended, that this is approaching the end of the process. I'll mention this briefly, but it is a whole different world, because under IFRS, all leases of more than 1 year now have to be recorded on the balance sheet of the lessee as an asset, and they're described as right of use assets. And you value the asset based on the discounted value of the future lease payments. So if you're paying, I mean, this is a whole other course and topic in itself, but if you're paying 100,000 a year and the lease is for 5 years, what you would do is work out what is the value of that adjusted for your cost of capital. So you would adjust it for your future investment. And so it might be that the 500,000 you think has a current value of about 450. What you would do is you would record an asset of 450, which you're then going to amortize, and you are then going to record a liability for 450. Because you actually pay 500, that means you are effectively paying 50,000 extra because you've leased it. And what is that for? Well, it's rewarding you for the time value of money. So that is a finance charge. That would be recorded as a finance charge on the liability. Now, this is what they've gone to under IFRS. This has added billions of pounds to companies' balance sheets. Obviously, nothing has changed. You're still committed to paying 100,000 a year. But if the landlord gives you a concession, if the landlord makes a significant change to the lease term, that is described as a modification, which basically could mean, if it was significant, you treat it as the old lease being terminated and the remaining asset written off, the remaining liability cancelled, and a new lease being started, just for a 2-month concession. So again, there were further issues here. If you really felt it was just a temporary concession, you could argue that the landlord has just varied the lease payments, which means you would carry on with the accounting, you just wouldn't pay any cash over the period. As I say, this is a complete other world, so we could spend the rest of the morning, the rest of the day on the new approach to leasing, but luckily in the UK, it's not such a problem. If you do decide you're not going to use the lease at all, and again, I'll only focus on the UK side of things. If you do decide you're not going to carry on using this lease at all, and you're not actually going to use the property, it now becomes known what we call an onerous contract. And from as soon as you make the decision, you've got to work out how much you think that decision is going to cost you. And again, you estimate what you think is the most likely cost to exit the agreement. If we think we can negotiate the exit with the landlord by paying a lump sum, we'd record that immediately as a liability. If we think we're probably going to have to just carry on renting it and hope we can sublet it to someone else, you would then obviously look at the future rental payments, which you would adjust to their current time value, like you would do under IFRS. But you would also then look to see if there is any chance that you could sublet. If you think you could sublet it at 10,000 a month, but that is only 50% likely, you would include 5,000 a month as a deduction. That is soon as the contract becomes onerous. If you've got, I don't know, if you're a small taxi company and you've got, you know, contracts and you've got people paid to, you know, take kids to school, and you've carrying on got to be paying for those drivers to be available for all the time that schools were closed, that could give you an onerous contract. I don't know what your personal view on this is. It is possible that some of the expenses may have been covered by insurance. Now, it wasn't really that likely. Very, very few businesses had pandemic insurance, but it might possibly be that some of the costs of travel disruption, some of the kind of more medical related expenses, maybe some of the other kind of business disruption issues we faced around Brexit are covered by insurance. The main thing to appreciate, you segment the two elements. You record the cost as an expense, as a reduction to an asset, as an actual expense. The insurance recovery will be recorded as an asset as soon as you consider it to be virtually certain. So this is really asking the question, at what point would you consider a receipt from an insurance company to be virtually certain? Now, sadly, unfortunately, I had a small car accident in August. Not my fault. No one was hurt. I was on the M25 going nowhere as usual. And we were stationary, and the car behind, which was driven by two lovely Italian gentlemen who had just landed at Heathrow. They were in a hire car. Everything was the wrong way around, and they went into the back of me. Caused a bit of damage to my car. I had to pay the repair costs, and now I'm waiting to get my money back. It's not a fortune. I only had to pay a kind of £350 excess, but I'm waiting to get my money back. When will I include that in my accounts? When it's in the bank. Until it's safely in the bank, I am not going to even think about receiving it. So you would most likely record the asset when you've got it in the bank, and what you would then do is credit to the P&L account as income. Wherever you reported the loss in value to the asset, or wherever you reported the increased expense or the reduction in revenue, you would record the insurance recovery to the same place, and it is taxable. Which obviously, if it means corporation tax rates starting to go up, you might have the expense in one period and you're going to have the income in another period. And the expense might be able to be deducted for tax at one rate of tax, but the income might be charged at a higher rate, which seems unfair. But that is just the way it works. Life is not always fair. And I have seen an example where HMRC enforced this absolutely strictly. This is not a new issue. It's a problem which has been around for many, many years. The pandemic, Brexit, has maybe called it back into kind of focus again. If I can take this as a timeline, and let's say you've got a year end which is 30th of September, and you've got various loans, you've got an overdraft, you've got other kind of credit facilities, but you've got a long-term loan. You've got a long-term loan from the bank, 5 years, which you can repay in installments, and there are certain conditions attached to it. It is often the case in these agreements that if you've breached any of the conditions, it will become repayable on demand. So even if it's a 5-year loan, if for whatever reason it was in breach at the year end, even if it is just a technicality, you know, you should have submitted management accounts, but you didn't because you were on lockdown. If it is in breach and repayable on demand at the balance sheet date, unless you've got clear evidence from the bank that they are not going to enforce their power of recovery, it means it would be reported as a current liability. Obviously, that can completely change the presentation of the balance sheet. Suddenly, you've got net current liabilities. It looks like you can't pay your debts as they fall due. Credit rating agencies' wheels might start to fall off. Nothing's changed. You just hadn't submitted some paperwork. This often seems really unfair, especially if the bank have told you a couple of weeks later, everything's fine. You've now caught up, we are not going to enforce. But that is why I'm reminding everyone of this. Obviously, you need to engage with the bank before the year end and document it. With everything else going on, for many companies, that is not a top priority. That is not the kind of #1 concern at the moment. Now, you will appreciate that a lot of these issues are if, buts, maybes. Have you done this? Could this apply? And it is really just to give you a feel of all of those areas which might be changing in the accounts. The next topic is one where almost every company will have been affected to some extent. Obviously, it's been well reported, things like furlough grants. It's been well reported, things like self-employed grants, which have kept people going, and other kind of support schemes granted by the government. So what I will do here is take a break. After the break, it will be back to the original recording. So hopefully you found this useful so far. The second part is on a separate recording, which is as was originally delivered in September. My name's David Potts. I am a chartered accountant. I hope you found that useful and helpful in steering your way through accounts until we get out the other side of things. Okay,